corporate insider selling of US stocks has just made an all-time high. This chart shows us the ratio of selling versus buying that is currently being executed by corporate insiders. Going back to 2004, we've never seen a ratio of selling to buying this elevated. Now, you've probably heard the headlines of investors like Warren Buffett and Michael Burry selling out of their US stocks, but we've also had a countless number of corporate insiders that are also selling shares of the companies that they work at, and that includes Mark Zuckerberg, that recently sold the equivalent of about $14.2 million worth of his shares. Corporate insiders are people who likely do have inside information regarding the inner workings of their company, and by law, they are obligated to publicly disclose whenever they make a decision to buy or sell the stock that they may have inside information on. And so these corporate insiders are followed very closely by retail traders as a way of gaining an edge on particular stocks. If the CEO, the CFO, and the COO of a company are all buying as much stock as they can, it probably means they have a reason to feel optimistic about the future performance of the company. So the chance of you performing well in the short term by buying that particular stock are probably higher than average. But what we're looking at on this chart isn't just for one particular company. This is the total amount of insider selling versus buying that is being done each quarter on all S&P 500 companies. The idea behind this would be that these spikes in insider selling should correspond to moments where the stock market is the most vulnerable to seeing a decline. Now, if you've been watching our videos for the last year, you'll know we've been advocating to be net long on the stock market, and that has worked out for us pretty well. It's allowed us to make some pretty incredible trades during this period. But now that we're seeing this spike in insider selling, should we be getting ready for an imminent market collapse? Is all the fun about to come to an end? Well, for starters, we have to understand that this chart is a ratio. So it's not actually telling us whether corporate insiders are selling their stocks. An elevated ratio on this chart could just be a result of a lack of buying rather than insiders dumping their stocks on unsuspecting retail investors. So let's take a look at what corporate insider selling actually looks like today, and we can see indeed corporate insider selling isn't actually particularly elevated right now. If anything, it's at quite low levels. Previous instances where insider selling was at these levels included late 2018 and early 2016. When we look at what happened to the S&P 500 index following those instances, these moments actually corresponded to bottoms in the stock market. If we look at corporate insider buying, however, that is at one of the lowest levels of the last 15 years. Now, we could argue that this is quite a worrying development. After all, if corporate insiders are not buying their own stocks, it probably means there's something fishy going on underneath the surface. It could also mean that these corporate insiders just believe that the price of their stock right now is too expensive and that it's not a particularly attractive time to buy. And we know that to be the case today. This chart shows us the percentage of companies in the S&P 500 that have what's called a PE ratio that's above 20. PE ratios are a way for us to gauge how expensive a stock is, and anything above 20 is typically when most people can agree a stock is becoming expensive. Right now, about 50% of stocks in the S&P 500 have a PE ratio above 20. We've only seen this many stocks at these expensive levels a handful of times going back to 1998, and in most cases it was for quite brief periods. Many of these instances were quickly followed by a correction in the valuations of these stocks. There is one big exception, however, and that is in 2020, valuations stayed at these elevated levels for almost 2 consecutive years. If you were expecting a correction in stocks based on these valuations during this period, you would have missed one of the most powerful stock market rallies in history. The high valuations that we have today is something that we talk about with our clients all the time. And anyone participating in the market today needs to be aware that this is a risk today. But we have absolutely zero guarantee that these valuations are going to deflate anytime soon. Now, the question is whether the lack of insider buying that we are seeing today is sending us a message that valuations are indeed about to collapse. So let's take a look at the track record of corporate insider buying against the S&P 500. Now, you can see all the moments where insider buying was elevated, like in these instances right here. Well, pretty much all of these corresponded to some pretty great bottoms in the stock market. So one big takeaway is indeed that when corporate insiders are buying, so should you. But is it also true to say that when they are not buying, that you should be selling? Well, when we look at the last 4 times that insider selling was at low levels, that was in June of 2014, which did not correspond to a big peak in the market, in October of 2016, which was also not a big peak in the market, January of 2021, also not a big peak in the market. Then you had September of 2021, which was about 4 months before the market peaked in January of 2022. You can judge by yourself whether that's close enough to the peak. And then finally, we have February of 2023, which was definitely not a big peak in the stock market. So the answer is clearly no. You should not necessarily be selling stocks when insiders are not buying like today. And that is really all this elevated ratio is right now. It's a lack of buying, not necessarily a lot of selling. In fact, when we compare this ratio to the S&P 500, we see that the last time the ratio reached these kinds of levels was actually in early 2021, and clearly that did not correspond to any type of big peak in the stock market. Prior to that, we had a spike in this ratio towards the end of 2016. That one is quite interesting because it came right after Donald Trump's election in 2016, very similar to today. And we can see stocks rallied significantly following that reading. Then again, in mid-2014, that wasn't the best time to be buying stocks, but it also didn't mark any type of big peak. So yes, there are corporate insiders that are selling right now, but no, unlike many of the headlines that you'll see in news outlets, insider selling is not at unprecedented levels, and to us, it really doesn't show a great track record at timing corrections. So for us, turning bearish on stocks today based on this spike would be as if we turned bearish on the stock market in March of 2021. Yes, it was quite expensive, but we had absolutely no signs that the stock market bull run was coming to an end. That only came in the first quarter of 2022 when the stock market started to move below its key moving averages. Right now, that's definitely not the case. The S&P 500 is in a very strong uptrend above all of its key moving averages. As a result, we still do very much have a net long exposure to the stock market. However, we just sent out a memo to our clients regarding the possibility of short-term downside risk. We think a pullback over the next couple of weeks towards 5,600 points is within the cards here. That would really be the max drawdown right now, and if it does happen, we'd expect the market to move substantially higher from there. But we did initiate a hedge trade shorting the S&P 500 to protect our returns against the possibility of this happening. You can follow all of our trades and our entire strategy at bravosresearch.com. Check out our homepage if you want to see all of the closed trades that we've had throughout 2024.